The banking system plays a critical role in modern economies, providing financial services to individuals, businesses, and governments. Banks operate on a simple business model. They take deposits from customers and use those funds to make loans. When a customer deposits money in a bank account, the bank is free to use those funds to make loans to other customers. This process is known as fractional reserve banking, as banks only need to keep a fraction of their deposits on hand as reserves. Banks are required to maintain a certain level of reserves, known as the reserve requirement, which is set by the central bank. The reserve requirement ensures that banks have enough cash on hand to meet customer demands for withdrawals and other transactions. How banks make money? Banks make money by generating revenue from their various financial services. The primary sources of revenue for banks are net interest margin. The net interest margin, or NIM, is the difference between the interest earned on loans and the interest paid on deposits. Banks make money by charging a higher interest rate on loans than they pay on deposits. Banks earn a spread on the funds they lend out. The NIM is affected by changes in interest rates, loan default rates, and competition from other lenders. The NIM is a critical metric for banks, as it represents their primary source of revenue. Credit cards. Banks issue credit cards to customers, allowing them to make purchases with borrowed funds. Banks earn revenue from credit cards through interest charged on balances not paid in full each month, as well as fees such as annual fees, late payment fees, and balance transfer fees. Credit cards can be a significant source of revenue for banks, particularly for those with large credit card portfolios. However, credit card lending also carries significant risk, and banks must have strong risk management practices in place to mitigate potential losses. Fees and commissions. Banks charge fees for a wide range of services, including account maintenance, ATM use, wire transfers, and foreign currency exchanges. Banks may also charge commissions on certain types of transactions, such as stock trades or investment management services. Fees and commissions can generate significant revenue for banks, particularly for those with large customer bases. Investment and trading income. Banks may invest and trade in various financial instruments, such as stocks, bonds, mutual funds, and currencies. Investment income is generated by earning dividends, interest, and capital gains, while trading income is generated by earning profits on these trades. Banks must have a strong investment and trading strategy. Also, risk management practices in place to ensure that they generate positive returns on their investments, because trading activities carry significant risk and can result in losses if the market moves against the bank. Insurance and wealth management services. Banks may offer a range of financial services, such as insurance and wealth management services, to their customers. Insurance services can generate revenue through premiums and investment income. Wealth management services generate fees and commissions for the bank. Regulation and risk management. Banks operate in a highly regulated environment, with rules and regulations in place to ensure that financial institutions are accountable for their actions. The central bank and other regulatory bodies set rules related to capital requirements, liquidity, risk management, and consumer protection. Banks must comply with these regulations and demonstrate that they have strong risk management practices in place. Banks face various types of risk, including credit risk, interest rate risk, and operational risk. Credit risk refers to the risk that a borrower will default on a loan, while interest rate risk refers to the risk that changes in interest rates will impact the bank's profitability. Operational risk refers to the risk of losses due to inadequate internal processes or external events. To manage these risks, banks have established risk management departments and employ various risk management techniques, such as diversification of loan portfolios, stress testing, and hedging strategies. Additionally, banks may purchase insurance to protect against certain types of risk. By understanding how banks operate and generate revenue, you can make informed decisions when choosing financial services and managing your finances. If you get value from this video, let us know by smashing the like and subscribe button. Thanks for watching Successeum.